Good afternoon from London. It's a wonderful day here. Unusual, but yes, true. We're here for cohort 10, the webinar on capital and liquidity regulatory update. Brief about me. So we've been dealing with the regulatory updates in the last 6 months, for example, the key regulatory updates, that is. I'd recommend if there are any questions along the way, by all means, mention them. But I'd request that they be posted on the forum so that the experts in the specific subtopics are best placed to address them. So starting off with the 3 key regulatory updates that we've seen in the matters of capital and liquidity in the last 6 odd months. The first one being the policy statement 1319 relating to Pillar 2 liquidity, providing the updates to the framework. So we'll deal with that first. So this update was released in June 2019. It's relevant to UK banks, to building societies, to PRA designated investment firms, and to non-EU EEA banks. The principal updates that it has are 5, covering the regulatory reporting part of the PRA rulebook, the statement of policy relating to Pillar 2 liquidity, the supervisory statement 2415 covering supervising liquidity and funding risks, supervisory statement 3415 covering completing regulatory reports, and the PRA 110 template and its reporting instructions. Taking the first one first, regulatory reporting part of the PRA rulebook, it has 2 annexures. The first annexure comes into force from 1st July, or has come into force already actually, from 1st July 2019. It impacts the FSA 47 and these parts of the FSA 47. Correspondingly, unsurprisingly, the same parts of the FSA 48. And it also updates the PRA 110 subparts as mentioned here, along with the relevant timelines. Annexure B comes into, or has already come into force again, 1st January 2020, and it impacts the PRA 110 timelines. The statement of policy on Pillar 2 liquidity, the updates to that are covered in chapters 2 through 6, covering, in case of chapter 2, Pillar 2 liquidity guidance, chapter 3, assessing cash flow mismatch risk, 4, assessing franchise viability risks, 5, assessing intraday liquidity risks, and the last, assessing other Pillar 2 liquidity risks. The third update relates to the supervisory statement 2414, which covers supervising liquidity and funding risks. The 3-part update here, the first has a few subparts in itself, covering short delay to the application of guidance to survive any granular LCR stress scenario. Such that the PRA 110 reporting template reflects the information which is needed. The update reflects the information which is needed for monitoring of metrics, and the assurance that PRA provides that will give the firms at least 2 months notice of the date of its application after 1st Jan 2020. The second part of this update, it removes ambiguity. Whether the firms need to wait for PRA's notice to increase the frequency for the PRA 110 reporting, particularly in times of stress. So it removes any ambiguity there, which is quite helpful. And the third part is where the PRA clarifies that it will be, and thankfully clarifies that it will be proportionate in its approach relating to additional or more frequent reporting in times of stress. The fourth part is the supervisory statement 3415, which covers the guidelines for completing regulatory reports relating to the period 1st July to 31st December 19. The 2 parts of which the first one includes a link to the updated PRA 110 template, which has taken effect from 1st Jan 2020. And the second part includes the existing PRA 110 template, and it has instructions on how to use it between 1st July 19 and 31st December 2019 as well. The last update relating to the PS 1319 relates to the PRA 110 template as such and its reporting instructions. So this pretty much covers the updates related to the policy statement 1319. Now we will deal with the updates related to the policy statement 2619, which covers the PRA 110 reporting frequency and threshold. This update was released in December 19 and is relevant to PRA authorized UK banks, building societies, and PRA designated UK investment funds. The implementation date is for 1st May 2020. The updates here contain two parts. First is the reporting part of the PRA rulebook, and the second is the supervisory statement 2415, which relates to the PRA's approach to supervising and funding risks. The first part, which relates to the reporting part of the PRA rulebook, it impacts the specified sections of the PRA 110 and their respective timelines. The second part, covering the supervisory statement 2415 relating to supervision of liquidity and funding risks for CRD4 funds, covers, as mentioned here, shown as sections 2 through to 7, quite a large part of the liquidity and funding risk process, management process. When we take the first one, the reporting part of the PRA rulebook, this is relevant for UK banks and building societies, basically the group of entities mentioned here. For regulated activity group 1, PRA 110 daily reporting, daily, weekly or monthly reporting of parts 2, 3, 13 and 14, the expectation is that during specific liquidity stress or market liquidity stress, the weekly reporting frequency, how that will change, we will see here. So for regulated activity group 1, the weekly reporting frequency in times of specific liquidity stress or market liquidity stress, if they were expected to report on a weekly basis, changes to daily. And if they were expected to report on a monthly basis, in case their assets are greater than or equal to 5 billion pounds, then the expectation is for them to start reporting on a daily basis. And if the assets are less than 5 billion pounds, then the expectation is to report on a weekly basis. Whereas for the regulated activity group 3, in relation to the PRA 110, parts 9, 10, and 11, where they had daily, weekly, or monthly reporting, the weekly reporting moves to daily, and the monthly reporting, based on the size of the assets, as mentioned in the previous section, changes to either daily or weekly, if it was monthly. So that's the reporting part. Then covering the supervisory statement 2415 for supervision of liquidity and funding risks for CRD4 firms. We'll take that now. This will be effective 1st May 2020, and it covers a whole host of sections under this process. We'll take them one by one. Section 2, which is related to the ILAP, we find here that this covers the bulk of the ILAP process. The updates cover the bulk of the ILAP process, starting all the way from ILAP governance, the governance involved in preparing the ILAP itself, or not just preparing it, but preparing, submitting, and following the ILAP document, as also the production of the ILAP document, moving on to the transition for relevant firms, transition from ILA or ILSA to ILAP, and then on to the overall liquidity adequacy, unsurprisingly including stress testing as well, as also intraday liquidity risk management. Management of HQLA 2 has been updated, as has been the diversification of assets. The eligibility of reserves held with the Bank of England has also undergone an update. Liquidity contingency plan 2, there have been modifications, as also in relation to transfer pricing. So it covers the bulk of the ILAP process. Section 3 relates to the LSTREP. In the 3-part update involves setting the ILG, Pillar 2 guidance, and the Pillar 2 asset eligibility. Section 4 relates to drawing down on the liquid asset buffers. So this in 4 parts is during stress times, when falling below quantitative ILG, the expectation is to be able to build or rebuild buffers over a reasonable period of time. And there is also an expectation for firms to notify the PRA immediately, either on actual or an expected fall below their respective quantitative ILGs, to also discuss with their supervisors plans to restore their quantitative ILG. A reasonable time will be expected or given which will factor in the liquid asset buffer levels, which will factor in also the stress duration that the firms are experiencing. It will also factor in the drivers for the shortfall as to what's actually forcing the firm to run into negative territory, as also the context of the current and the forecast conditions, and the amount of pre-positioned collateral that the firm holds, and finally the amount that it holds with other banks. The part 4 of the update to drawing down liquid asset buffers is that the firms have to have robust pre-positions and flexibility needs, and there is also the expectation for pre-positions to be part of the liquidity contingency plan. Section 5 relates to the collateral placed at the Bank of England and updates related to that. So the 4 updates here essentially relate to the firms meeting threshold conditions, signing up to the SMF to be able to access the Bank of England's facilities. The Bank of England's liquidity insurance, it incentivizes firms to manage liquidity, their own liquidity, privately in normal times without recourse to the facilities by using their HQLA in times of stress, using the discounting facility alongside their liquid asset buffers, and having in their liquidity contingency plans credible options to restore their HQLA. Then there is also the update related to pre-positioned assets counting for quantitative ILG if they are eligible for HQLA. And the PRA also expects firms to have robust pre-positioning, and it acknowledges the need for flexibility that the firms need to use these for market funding. The updates related to reporting are 5, and the firms which are not meeting the LCR are expected to start reporting LCR, stable funding, and other metrics on a daily basis to the PRA, unless it has been otherwise approved previously. In times of stress, where the balance sheet is greater than £5 billion, daily reports, as mentioned here, are expected to be provided. And during times of stress, if balance sheet is greater than £5 billion, the firms are expected to report their PRA 110 on a daily basis. Where the balance sheets are less than £5 billion, the expectation is to provide PRA 110 reports on a weekly basis. Firms are also expected to have systems and processes to support the accuracy and frequency of all of these returns. In times of crisis, unsurprisingly, the PRA expects all firms to have capabilities to produce key data that is needed either for liquidity buffers or for contractual or stress cash flows, whole counterparties, or for the FSCS scheme. The last update relating to Supervisory Statement 2415 is for disclosure of Pillar 2 guidance. That being a 2-part update, the first one relates to firms reporting all eligible HQLA within LCR for Pillar 1 and Pillar 2 and eligible surpluses, and clearly stating that LCR covers both pillars. PRA also makes it quite clear that they expect firms not to have to publicly disclose their total ILG, apprehensive of the fact that any such public disclosure may lead to a market expectation for firms to hold their liquid asset buffers in excess of their respective ILGs. That pretty much covers the second part of the policy statement That covers the updates related to the Supervisory Statement 2415, which in turn is the second part to the update to the Policy Statement 2619. Completing that, moving on to the updates related to the Policy Statement 220, which relates to the Pillar 2 capital and an update to that framework. Now, this update was released in January 2020, is relevant for PRA authorized banks, building societies, and PRA's designated investment firms. It contains updates relating to setting Pillar 2 capital and the PRA's methodologies for that. Updates also to the Supervisory Statement 3115 relating to ICAP and SREP. And finally, the update to Supervisory Statement 614, which is relating to the implementation of CRD4 capital buffers. So dealing with the first one, where relating to setting Pillar 2 capital and the PRA methodology relating to that, that's divided into 7 subparts. The first being assessing Pillar 2A credit risk and updating its benchmarks. Second being commercial real estate exposures and providing the range in IRB risk benchmarks, excluding expected loss. Change of AFS into FVOCI in market risk methodology, clarifies the buffer setting process, and onward the Pillar 2A requirement in stress testing and scaling basis. Updates also to buffer interactions and usability, and finally updates to risk management and governance assessment. The second part relates to Supervisory Statement 3115 for ICAP and SREP. The updates add a link to PRA's expectation for ICAPs for financial risk from climate change, as all of you would know, very, very topical. And it deletes references to AFS, and Pillar 2 projections for stress testing are also updated. Buffer usability is the other update. It deletes references to GenPro. It provides minor changes and corrections and clarifications as well, as also deletes the transitional arrangements section for phase-in of quality of capital. And this will be effective 23rd Jan 2020. The third part of the update relating to the Supervisory Statement 614, which relates to implementing CRD4 capital buffers, is also effective 23rd Jan 2020. And the update is also providing clarity on usability of buffers and the considerations in the PRA's assessment of the use of buffers. This pretty much completes all of the key regulatory updates that we have for you today. I would highly recommend going through in detail all of these 3 documents to better understand the scope of the updates and the extent of the updates and its consequences as well. As mentioned earlier, if there are any questions, I would request that they be posted to the forum for them to be answered. Thank you.